Hi, everyone. My name is David Toll. I'm the publisher at Private Equity Career, and I'm going to be the host and impresario of the program today. Um, I thought we'd start a little early to welcome you. You've obviously you're eager to get started, and you're signed on about 5 minutes early. So to reward you, I wanted to help you make the most of the program. One way to do that um, is to go to the top of your screen and look for that icon that looks like a piece of paper with a paper clip attached to it. And that's where you can find the handout from today's presentation. There's um, a slide presentation from SBS by With Intelligence. And we also have there a copy of survey results from a survey of BD professionals that we conducted just about 2 years ago. So look at that as well. Um, Otherwise, make sure that you avail yourself of the question feature at any time during the program. I'll be keeping an eye on questions that come in, and you can ask questions. Again, go to the top of your screen, look for the little screen with the question in it, pop that open, and that's where you can ask questions. So we've got about 3 minutes left before we start the formal program, and I thought we might hear about how our speakers spend their time outside of the office, hidden talents, hobbies, that kind of thing. James is smiling, so I have a feeling he's got something really good that he does outside of work. So James, you're on.
I don't think it's particularly different from others, but avid golfer. I guess something unique is I was a minor in studio arts, and I have a 6-year-old who really loves doing that. So we do a lot of painting and arts at home, so it's a lot of fun.
Okay, that's really cool. Great way to spend time with the kids.
Yeah.
And Kristen, hidden talents. I'm sure you must have some.
Well, I've discovered this hidden talent recently, which is baking with three toddlers. Feels kind of like a hidden talent. It's a way to kind of try to focus their energy for, an hour to 90 minutes before, of course, the sugar high that comes on once we've baked. But yeah, it's been a real test in patience and tenacity for sure.
So, what's their favorite thing to make, Kristen?
Well, I've been trying to say that, we're still learning, but of course, the first thing on their list was chocolate croissants, pain au chocolat, which is probably one of the hardest things to make because the bakery is always going to do a better job. So
Yeah.
we've slogged our way through that at least once.
Okay, those are both good. And thanks to everyone who've joined just a couple of minutes early. I thought I'd reward your promptness by giving you some insights into how our speakers spend their spare time. Um, Bobby, you're up.
Well, I've learned my secret talent is I'm a great taxi driver because that's pretty much all my free time these days. I've got three little girls, and I've learned a whole lot about ballet, about theater, about dance, and that's become my whole life. So very different from the stuff I grew up participating in, but my days, nights, and weekends are spent shuttling between all those and sitting in the audience and watching. So that's my special talent these days.
Okay, that makes you a girl dad to the third power, I guess.
It is definitely girl dad world over here.
All right, well, it's really good to hear our feature speakers are spending time with their kids. And Brenden, you look a little too young to have children, but how do you spend your spare time?
Let's see. Well, right now I'm trying to decide if I need to call a plumber or a septic company after my 3-year-old decided to flush the actual
You have kids.
metal, the metal rod that holds toilet paper, right? Yeah, he took that whole thing and flushed it as an experiment. Who knows why? So besides chasing that little guy around, which is actually a ton of fun, I'll just try to spend as much time outside as possible. Whether it's hiking, skiing, or just building something in the yard, just try to get outside.
Okay, well, I want to thank our speakers for giving us a few insights into how they spend their spare time. And it's great to hear that everybody's spending time with their kids, even Brenden, who looks too young to have children.
There's some gray there. It's coming in.
All right, let's get started with the formal program. Good morning, welcome, and we're very grateful to have you here for a special private equity career news webinar. It's called The Evolving Deal Landscape, Shifting Deal Sources and Emerging Exit Strategies. My name is David Toll. I'm the publisher of Private Equity Career News, and I'll be your impresario for the program today. Many of you this morning woke up to read news that astronomers had found signs of life in a distant planet. And today we're going to try to find where the life is in the private equity M&A market. I'd like to start out thanking our sponsor, SBS by With Intelligence. They are an award-winning provider of actionable data and analytics for private equity firms seeking to optimize their deal sourcing efforts. Few housekeeping announcements before we really dig in. First, a friendly reminder to any reporters on the program today that we are off the record. Please reach out to the speakers individually for permission if you would like to use anything that they say today in an article, and that goes for me as well. Second, you can download a copy of the slides from your control panel. You can find the control panel from the top of your screen. There's an icon that looks like a piece of paper with a paper clip attached to it. You can also there download a copy of the results of a 2023 survey of business development professionals. It includes some valuable information on industry BD practices. As a side note, we will be conducting a survey again this year, so please be on the lookout for that and participate if you get it. Later today, I will be sending you a recording of today's program, so no need to take extensive notes unless you really want to do that. And finally, many of you asked really good questions when you registered for the program. I will plan to address those questions during the discussion portion, but please also feel free to ask questions at any time during the program, and you can do that through the question feature. Again, go to the top of your screen and look for the icon with the question mark in it, and that's where you can open up the box and ask your questions. Okay, I'm grateful to have 4 expert speakers today to guide you through the topic. We have Brenden Gobell. He is based in New York City. He's the managing director and head of data at our sponsor, SBS by With Intelligence. We are very happy to have Christen also based in New York City. She is co-head of the North American buyout team at MiddleGround Capital, which is based in Lexington, Kentucky. We also have 2 investment bankers on the program. Bobby Reifman is the Chicago-based managing director and co-head of the industrials practice at Lincoln International. And we have James Schiro, also based in New York City, managing director of private equity solutions at Moelis and Company. So in summary, we have a private equity rainmaker, we have 2 investment bankers, and we have an expert in data and analysis. So let's find out a little bit more about our speakers, starting with Christen. Christen, tell us about MiddleGround Capital and your role there. And before you do that, Christen, I am getting some background noise. So I would ask the other speakers for the moment to go on mute, and hopefully it will resolve itself. But Christen, tell us more about MiddleGround Capital and tell us about your role there.
Sure. So nice to see everyone today. Christen Paris. I'm a partner at MiddleGround Capital. We're a middle market buyout firm focused on industrial manufacturing and specialty distribution. I've been at MiddleGround for 6 of the 7 years we've been around. We're currently investing out of our 3rd flagship fund and have 19 platforms. And we employ a very hands-on operational approach with operators who come from various parts of the industrial sector to drive improvement as we partner with our management team. So it's good to be here today.
Good to have you on the program, Christen. And let's move to Bobby. Bobby, tell us about the industrials practice at Lincoln International and your role in it.
Yep, great to be here. I'm partner and I co-head our industrial group at Lincoln. Lincoln consists of about 1,000 bankers now globally. I spend my time focused on the mergers and acquisition space, mainly sell side. Bulk of that for private equity clients, and then for corporate and private clients. On top of that, we've got extensive practices within capital advisory, valuations and opinions, and private funds advisory. Good to be here.
Super, glad to have you, Bobby. And James Schiro with Moelis, tell us about Moelis and your role there.
Yeah, so as you had said, James Schiro, I'm a partner based in New York in the private equity solutions team. I've been with Moelis for almost 11 years. We're about 1,300 employees across the globe now, with 23 different geographic locations, which is a multiple on when I joined, which I think was around 300 or so people total. Focuses on investment banking, advisory more broadly, including sell sides, capital markets, capital structure solutions, and a variety of other advisory assignments that we help across every vertical you can imagine. So appreciate you having us today.
All right, glad to have you, James. And now I'm going to turn it over to Brenden Gobell with SBS by With Intelligence to introduce himself. He will also go through a brief presentation to shed some light on the current state of the market and what's been happening over the last few months.
Thank you, David, and thank you everyone for joining us today. For those of us in the Northeast, hope everyone is enjoying this balmy weather, and more importantly, staying healthy with everybody coming back from spring break. We all know how that tends to spread everything around. At SPS by With Intelligence, we are continuing to do what we do best, which is helping our clients find the people they need to know to source the deals that they need to close. We do this panel every quarter, and I wanted to share my comments from January, just a few months ago. Let's see. Well, the election is behind us, so that happened. Interest rates still in a decline, and inflation coming to check. Seems like simpler times compared to the current environment, but we'll see how things shake out 3 more months from now when we do this again in July. Really looking forward to hearing the perspective of our panelists, who are great at what they do and have been doing it for longer than they'd probably care to admit, each of them grappling with many of the same questions as our audience. So I'm going to spend about the next 10 minutes or so, probably a little less, walking through some slides to help frame our conversation, and then we'll let the inmates run the asylum with an extensive Q&A. We're starting high level with total PE and M&A volume, which has been steadily declining from a record high in 21. Now that last year's data is fully baked, that trend is officially broken, with 2024 deal volume increasing a little bit, actually 4% year over year. Now, is this just a temporary reprieve? The only time will tell. The trend that began in 2020 of private equity representing a larger share of overall M&A activity compared to strategic buyers is still going strong, with PE activity representing 54% of overall deal volume last year compared to 55 prior year. Here's the same data broken down by quarter, which reveals the wild swings in deal activity over the past 6 years. Despite this turbulence, there are layers of consistency. For example, deal volume has been nearly identical between Q2 and Q3 for the past 3 years, which underscores how important the next few months are. Also, Q1 volume has always been less than the preceding Q4, often significantly. So nothing too crazy with what's going on now. However, activity last quarter is still down 12% compared to Q1 in the prior year, and still 6% compared to Q1 in 2023. That said, we continue to receive new deal announcements, and once the dust settles, we expect a slight uptick in the Q1 data. We climb back up to the annual view here, comparing sector activity over the last 3 years, split between strategics and private equity as buyers. The top 5 sectors by volume, that's industrials through healthcare, have been led by private equity for the past 3 years straight. Of the top 6 sectors by volume, all but healthcare saw year-over-year increases in total volume. very interested to hear from our panelists on where this is perhaps most or least likely to continue. All right, drilling down to private equity acquisitions only, we're analyzing how volume by deal type varies across sectors. For context, XPS tracks 4 deal types: add-ons, buyouts, financings, which is how we tag non-change control transactions, and then also recaps. Of the top 6 sectors by volume, all but one saw an increase in financings year over year. That's the gray section in each column. Even in consumer and healthcare, where total PE deal volume was down, financings were still up. Add-on activity peaked in financial services at 75%, followed by business services at 72% and industrials at 65%. Add-ons still comprised the biggest share, if not a majority, amongst transaction types across all sectors in 24, and are really the key contributor behind PE activity, representing a higher share versus corporate buyers of overall M&A for the past 5 years. The buy and build strategy has been rolling uphill since 2016, with the ratio of add-ons to buyouts growing continuously from 1.4 all the way up to 2.5 in 2023. Last year, it decreased slightly to 2.4, with total add-ons dropping just a little, but buyouts staying pretty much flat year over year. We have preliminary guidance included for 2025, which is very much still subject to change, but marching upwards yet again to 2.6. For now, at least, it seems the buy and build trend has room to continue. Looking at PE pipeline data, the median number of deals PE firms saw, or logged to be more precise, was 185 in Q1. Slightly down from the prior year, but still above 2023. Now, over the past decade, Q2 was the max of every single year except for 2020 and 21, and that was really just due to COVID. Now, this makes sense, right? Because deal making ramps up alongside travel and conferences in the beginning of the year with the goal of closing these same deals before year end. Point being, the next couple months will have an outsized impact on 2024 as a whole. So intermediary churn. This is something that doesn't necessarily get a ton of attention. Usually people focus on what are the new names I need to add to make sure we don't miss out on the best deals out there. Well, looking at the data, what we have of over 900 active intermediaries that closed at least one deal last year, 72%, nearly 3/4, closed 3 or fewer deals. That's the long tail, the boutique firms. 121 sold a business for the very first time, with a not negligible subset closed 2 or more. These are not just one and done firms. On the flip side, 276 did something in 23, and we don't have them closing anything in 24. That's a lot of churn, something to keep in mind as you're not just looking for new relationships, but also ensuring that the time you're spending making those calls, sending those emails, visiting in person, it's with firms that are still actively closing relevant deals that you want to be involved in. Given this webinar's focus on exit strategies, we borrowed this analysis on holding periods from our private equity harvest report that was just published in late Feb. The headline here is that PE holding periods are now 5.5 years on average, after steadily increasing from just under 4.5 years back in 2018. The second chart tracks the top 5 sectors by deal volume. In 2018, the spread across average holding periods is only half a year apart. But by the end of 24, this spread has doubled to a full year, with business services as the sole sector still below 5, and consumer closing in on 6. All right, so for context, market coverage, as SPS defines it, it's the overlay of a firm's deal pipeline against closed relevant transactions to identify new relationships, improve existing ones, and to close gaps in sourcing. As the industry standard for origination insights, the SPS Origination Benchmark Report is a biannual publication received by each qualifying SPS client tailored to their target investment criteria. And it provides benchmarks, as the name implies, on market coverage, deal flow efficiency, and sourcing performance relative to a peer group of similar private equity firms and the broader industry. So what you see on the chart here are those 8 peer groups mapped out, showing the max coverage, top quartile, and median. Not too surprisingly, firms that are focused on the upper end of the market in terms of just bigger deals tend to have a higher percentage because there are just fewer deals to go through. Those focused on the lower middle market, say 10 to 250 in enterprise value, typically have a lower median coverage because it's more fragmented. It's just more names to cover. And really, the point that we want to drive home and why the report was originally made was that it's not about hitting 100% market coverage. That's actually not possible, and it's not a good use of time. And context is everything. So if your peer group has a max of 30 and a median of 20, being over 20 is still very good. Context is king. And with that, I'd like to turn it back to our moderator, Mr. David Toll, and our panelists for the Q&A.
Fantastic. Thank you, Brenden. So let's go to a polling question to take advantage of the large size of the audience and the market intelligence in the room. And once we do the polling question, then we'll get into the heart of our roundtable discussion. This is a polling question that we've asked for a couple of years now, so it's always interesting to track it over time. Let me tee it up. So the question for the participants is, how do you expect your firm's total number of platform deals this year to compare with last year? So go ahead and make your selections. You can pick down from last year, even with last year, up to 10% higher than last year, or more than 10% higher than last year. When about half of you have voted, I'll end the poll and share the results. And here we go. Okay, so I think the headline number is at the top. 28% now expect that you'll do fewer platform deals this year compared with last year. And I don't remember exactly what the numbers were when we did the same poll about 3 months ago, but I remember it was nothing like that. It was sort of all systems go, very optimistic response to this poll. Now, at the same time, a healthy minority of you expect to do more platform deals this year, and 1 in 5 even expect to do more than 10% more this year than last year. So not everyone is pessimistic about the deal market this year. So I'm going to close that poll, and we're going to do one more, and this has to do, it's basically the same question, but we'll ask about add-on deals. So go ahead and answer this question: how do you expect your firm's total number of add-on deals in 2025 to compare with 2024? And again, I'm going to wait until a decent percentage of you have weighed in. So go ahead and make your selections. Okay, I'm going to end the poll, share the results. And again, this is for add-on deals and more optimism about the prospect for doing add-on deals. So only 17% of you expect to do fewer add-on deals this year than last year. Even with this year, about half of you, and then about a third of you expect to do more add-on deals this year than last year. Okay, so that'll tee things up for our roundtable discussion. And I have a question to kick things off for all of our speakers in turn, and that is what is the quantity and quality of deal flow like out there right now? And of course, we want to also hear the outlook for the rest of the year, given everything that's going on. In the words of someone who just submitted a question to us, given a world of new rules for global trade and economics. So, Christen, we'll start with you.
Sure. So we started the year kind of decent, flat to last year. I think, we're industrial investors, and a lot of industrials verticals had a pretty soft back half in 2024. So we weren't expecting necessarily January and February to start off with a bang. Those are traditionally not our highest deal, new deal volume months anyway. But I would say, a lot of industrials companies, I think are waiting for performance to sort of improve month over month, as we got into 2025. And then I think there was a lot of optimism across the deal making community with this administration that it would be really conducive to more M&A. I think there's still a bit of a question mark there as to how that ultimately resolves, but we definitely saw the impact of some of the uncertainty around tariff policies and geopolitical climate impact March results and definitely April. So while we were about flat in January and February from a kind of top of funnel perspective, March fell off, and then if we kind of continue on this pace for April, we'll probably be down 30+% relative to last year. So I think the year is off to a bit of a slower start. The deals that we are seeing have been higher quality, and the way we think about that is our senior team reviews every SIM that comes in the door, so members of our investment committee, and we've staffed more deals, which is a good indicator for us of quality, because it means that the IC has some level of conviction that we want to do more work and learn more about a deal versus kind of wasting or expending our very high value associates' time. So I mean, it's an interesting dynamic where we're staffing a bit more because I think what's come to market are higher quality assets.
And why is that, Christen? Why is overall deal flow down for you, but you're seeing a higher quality of deals? What's going on?
Yeah, I think it's twofold, right? I think it's a little bit of what I said, where you're having some of those industrial companies come to market that have started the year off strong from a performance standpoint, and then probably from a tariff exposure perspective are less than some other competitors in the marketplace. So I think those are two of the contributing factors that we've seen them where they're relatively isolated, maybe from that impact.
And Christen, what about as you look ahead to the rest of the year? Down significantly in April, but do you anticipate that things could eventually bounce back, or what's your thinking there?
Oh, the crystal ball question. I love giving these to the bankers, but let's say we'll hear from them. But I hope certainly that activity picks up. I think it's really a lot of what's driving some of the wait and see approach is the uncertainty, how all of this settles. Obviously the news out of Washington has been kind of constant and ever changing, and so it's hard to make a plan and to really think about how execution through the back half of the year will look when you don't know how the next 2 weeks will look. So I hope that as we get more clarity on policy agenda and some of the dust settles on some of the reciprocal tariffs and those trade dynamics, that deal activity will pick back up again, because we know from talking to our banking partners that there's a lot of pitch activity. Backlogs are high. I'm sure all been hearing that for a couple of years now. And so I think it's just a question of getting that clarity and being able to execute on your 2025 plan to give, certainty in your process.
Okay, thanks, Christen. And James, let's turn to you. And James, remind the audience maybe the industries that you're most familiar with. And again, talk about the quantity and quality of deal flow you're seeing right now and the prospect for the rest of the year.
Yeah, so I am fairly industry agnostic. So touch everything from industrials, but also tech, business services, media, real estate, gaming, and lodging, like a multitude of other energy transition, multitude of others. I would say, the amount of deal flow coming to market, that was kind of steadily increasing coming in from January, February, and a variety of different areas. But the tariff news that kind of hit put a little bit of pause on launching anything new for the time being. As Christen referred to earlier, pitch activity has been at a very fast rate ever since probably coming out of summer last year, and has been building steadily. I would note that as it relates to industrials, that's probably slower than some of the other ones, but I think that has to do with a lot of the dynamics that are touching industrials as a whole on a macro level, even outside of tariffs that they've been processing post COVID. But more broadly, it's been very active. It's not all sell sides too. It touches on everything from capital markets. So people with particularly sponsors trying to focus on DPI or trying to take some capital out, but also on some capital structure, whether it's a cap structure that's gone a little bit of sideways or some operational challenges. So across the entire spectrum, we've been exceptionally active. On a timing of coming to market, it is definitely kind of pushed until we get through the fog that we've been looking at, particularly since the tariffs. But I think that just takes some time to digest, and something that Ken has said recently, and we've been thinking is, come, if you close your eyes and imagine the end of the year, and you look at multitude of different factors and how you feel, Ukraine war, inflation, a variety of other factors, how you probably feel. And I think right now would probably say we're going to probably feel better, but that is a changing variable as we kind of keep going along.
Okay, thanks, James. And Bobby, same question for you. And again, remind the readers what industries you're most focused on, and we want to hear about deal flow right now and your outlook for the rest of the year.
Yeah. So I focus all my time in the industrial space, and I think we've hit some of the themes there. But what was interesting with industrials was 24 was a tough year from a volume growth perspective. A lot of businesses were flat to slightly down, not a lot of volume growth, and you had a lot of investors that were still kind of risk off. What we saw towards the end of the year going into this year was a little bit of the positive nature of people starting to put risk on and be more aggressive. Our first quarter was actually well up over last year, and we saw the momentum building. There still was very little in the market overall, but those businesses that did have volume growth were able to come to market, and we're getting very strong interest. So the past couple of weeks put a wrench into it, and it's just put an uncertainty piece to it. And as Christen said, the wait and see, which is tough because my view to a certain extent is I'm not sure there is a C here. And as things just keep getting kicked down and the things keep changing by the day, if we do the wait and see, we may have a year where deal volume falls off significantly because a lot of people have put the pause right now in terms of launching. The question becomes is when is there going to be visibility? As it changes by the day, it was tariffs that was there on April 2nd, that moved to 90 days. And is that going to change when we get to July? And that's going to be the big question, I think, that people need to decide of, hey, do we go? That uncertainty will be priced into a certain extent. But the reality is there is a lot of dry powder out there, a lot of money that needs to be put to work, a lot of people who want to do deals, and a lot of people were hoping for this year to be that. And I think there's a little bit of this pause and frustration now. What are we going to do? So those deals we do have in market continue to get very strong interest. They are higher quality businesses because those are the ones you're bringing to market in this type of environment and can be in market and getting a ton of interest from it. The question is, can you get those other deals out there? Christen said, I mean, everyone talks about, backlog. I think the BD folks in PE are probably sick of hearing the comments from bankers talking about backlog because it no longer means anything. It used to be a good proxy for what was coming and a sense of what it is. It's lost all meaning at this point because I think every investment bank talks about their backlog and pipeline. The opposite's actually happening where I've heard from a lot of PE firms, their pipeline is as thin as it's ever been. And I'm not sure there's going to be a much launching here in the coming weeks just because of all the uncertainty. The question is who's going to be on the front of when things do start launching and you get that pickup in activity. I don't know if that's going to be in the next couple of weeks, next couple of months, or it's really going to drag on.
Say, Bobby, can you speak to within the broader industrials area how impacted companies are by the tariffs? Because I imagine there's some sort of range and dispersion, but can you speak, is there like a decent sized sector that really is not impacted? I have no idea, so I'm really curious. I'm curious.
I mean, listen, again, it goes to unknowns. I think we're still trying to figure out what those tariff aspects are. We've got a lot of businesses, for example, that are sourcing from Canada a lot of aluminum and steel, and that just changes by the day in terms of what that tariff impact is. The businesses that are sourcing still from China significantly, that's going to be impacted. I think there's a view of you've got to shift from that. That's going to be a risk factor. A lot of the other tariffs are still kind of waiting to figure out what the final determination is going to be. The tariffs are probably a little bit less of a concern because the view is a lot of people learned from 2018 and from COVID of how to pass through pricing. There's been a very different view in terms of that ability to be able to pass through, and it'll go to that end user and the final price of it. I think the bigger piece that's the concern across industrials and probably the other spaces is just the recessionary fears. Does demand fall off? That's the bigger piece. Is you could work through the tariffs, that goes through pricing. You could figure all that dynamics out. It's more what is going to be the impact of a potential recessionary environment where demand falls off. And that's the bigger piece that I believe ICs are wrestling with when they sit down to decide on what they're going to do with the business is we know how they know how to handle tariffs, but is the demand, are we walking into something where demand is going to fall off by 30, 40% here in the back half of this year? That's still to be seen. It's too early right now to have any business really have a determination of what all the impact is from a demand perspective.
Okay, well, well said, Bobby. I appreciate that insight. And Brenden, let's turn to you. What are you seeing from customers? What are you hearing from clients in terms of deal flow and the outlook for the rest of the year?
Much of what's already been said by the other panelists. I was glad to see that at least for the Q1 flow, is really not that much below Q1 of last year. In fact, January and Feb were both above January and Feb of last year, but it's March that took a little bit of a nosedive for the reasons that we've already discussed. And just with everybody's already been trying to hold their breath for as long as they can, hold on to companies a little bit longer. I agree with the others that maybe it'll be a little bit more of a pause for another couple months or something to that effect. But there's only so long that you can hold back from doing deals or exiting when you've already been slowing down for a couple of years waiting for things to pass, especially when it comes to being able to return liquidity to LPs and hopefully get onto the next fundraise. So time will tell, but we'll see. a lot of questions, not so many answers right now.
All right, let's turn to Christen, our rainmaker on the panel. And Christen, she reminded me earlier that MiddleGround Capital has a European office, and they do platform and add-on deals there. So I'm very interested, Christen, for your global perspective on what industries and subsectors are still generating decent deal flow for private equity sponsors, and why that is.
Yeah, I mean, I think we've seen some pockets of, activity over the last, 6 to 12 months. I think anything touching the data center space has been quite hot. Even, us playing the supply chain there, kind of trades at above market multiples for businesses that, have the same manufacturing capabilities but serve different end markets, just because of the rapid growth of that end market. I would say that, we are not industrial services investors, but I was at DealMax last week and Chicago Heavy Hitters Industrials Conference 2 weeks before Liberation Day. And, a lot of the conversation was, well, we have a good bit of activity in industrial services, which is a little more insulated from some of the impacts on the manufacturing side, from a macro perspective or from a trade perspective. So, while we're not active there, we know that our peers and a lot of our banking relationships have been more active there. And then we've also seen, a little bit more activity in aerospace and defense, which can be more resilient with long-term agreements in place, and particularly on the defense side, where there is more steady spending. So have seen, a fair bit of activity in defense as well. So those are some of the sub-verticals within industrials where we've seen more activity.
Okay, thanks, Christen. Bobby, let's turn to you with the same question. And I know these are kind of special times with so much uncertainty related to tariffs and the trade war. But maybe you could also speak to your experience during what could be the run-up to a recession, like what kinds of areas of industrials tend to hold up better, or maybe are more recession resistant, and therefore buyers and sellers can get a little more comfortable.
Yeah, I think that the two sectors that are probably the most intriguing and the one that are getting the most interest and in it the highest valuations really gets around one, the power space. The power space has been extremely active the couple of years. And that hits a little bit of the data center dynamics, right? You've got an aspect of, I think everyone's come to agreement of, historically it was about how much power consumption, how do we limit it, how do you be efficient there? It's flipped around now, where you have all this demand that's going to be needed for electricity, and there's a lot of different ways to play it, and there's going to be a lot of investment into the power grid. We just closed a deal a week or two ago, business called Richards that was sold to TE for a very attractive valuation, and it was exactly playing on that. And there was a whole host of interested groups there, both from strategic and financial. So that's an area we're seeing a lot of momentum to. The other area that has really accelerated that a lot of people are trying to play is around the filtration space. As you think about recession resilience and areas of continuing growing demand, you're always going to need cleaner water, cleaner air. You have a lot of consumability aspects to those kinds of businesses. That's what people are looking for right now. As you think about kind of businesses that play well in recessions, it's ones where you have no choice. You've got to be swapping out the consumable products that exist there, and it's not something you can defer in terms of spending. So we've seen a lot of interest in investment, pretty attractive valuations within that space. The issue there is there's just not a lot of deals of scale, and finding those deals of scale are tough. So there's a lot of PE groups out there that have theses around these two areas, and it's very expensive to get into, and it's very tough to find those assets. But when you have one, very attractive right now, and that's where a lot of people are running to. And as Christen said, I mean, if you just throw the word data center in front of your business right now, you think your multiple just goes up by 5 times is how people look at it. So the question is going to be in that space, and it goes some questions later on that we'll talk about, is what's the sustainability there? Because everyone's thinking about, hey, when I go sell this in 4 or 5 years, what does it look like? It's great to have a business that's growing a ton right now. It's not going to be impacted by a recession, but the data center world, the power world's on a little bit of a different path of there's going to be a huge ramp up here. What does that look like in 4 or 5 years when you're at a more sustainable level? That's a question I think a lot of people are grappling with.
Okay, that was Bobby Reifman with Lincoln Data Centers International. And now we'll move on to James Schiro of Moelis. James, same question for you, and bear in mind, of all the panelists, you probably have the broadest view of the market, and so where are the hot pockets left?
Yeah, look, I think less impacted by tariffs is obviously a key focus, but areas such as Bobby and Christen already hit on data centers, P&U. I'd say technology, healthcare, energy transition, working off the same kind of themes that Bobby had touched on, but also more broadly in terms of multitude of different areas that you can kind of build off of energy services around that. That's been a key area that we have a massive team that's kind of come together over the last 2 years that has been driving a lot of activity in terms of that space, and it's been really exciting to see even with the slowdowns in some other areas, they've been kind of pushing forward pretty actively. I think the criticality of services has been really key, whether it's utilities, infrastructure, data center oriented, even some industrial services that are a massive necessity. Some areas of legal services, pharma services, Office of the CFO, where AI really can't replace that. That's been a really key focus in terms of buyers and where we've seen a lot more activity.
Okay, thank you, James. And Brenden, anything on an industry basis to add based on what you're hearing from clients?
Just seems like the general shift towards services, right, versus really balance sheet heavy types of assets, which has probably been going on for a while. A couple of the hotspots, certainly data centers. It's reminding me of back when hospice and home staffing was just getting started as the biggest thing, or when HVAC was just starting out. But also, yeah, certainly even just business intel and data businesses in general, anything that can work to actually deliver intel and synthesize output from multiple inputs, like systems integrators and things like that. It's a holy grail of being able to figure out how to actually make data do more. So if anybody is able to figure it out, I think it would do quite well. And then there's also just home services, which seems to still be chugging along, especially if people are a little wary about spending on vacations or some other things. They're going to be spending more time at home, and there's also more motivation to just keep spending on your home as well.
Okay, and that's coming from a relatively new homeowner.
Yeah.
Gobell, right? And sounds like the spending is well underway there in the Gobell household. So let's turn back to James. And James, I know market conditions change day to day, but we'd love to hear a snapshot of what are purchase and leverage multiples like right now as we speak for an A-plus company. Maybe it's in the data center space, but I guess we want to hear about the most, the high price stuff that's out there.
Yeah, look, I'd say just maybe starting on the lending side, we just secured lending and signed something up this past week in one of those areas. It was great to see it's over $1 billion transaction, and lenders really leaned in and were able to underwrite at an area that really felt comfortable in terms of continuing to get deals done, even with the backdrop of everything else that's been going on. You have a massive number of direct lenders, but also banks that are really pushing and making sure that they have share and they have a lot of capital to deploy. So that feels pretty comfortable. I'd say on A-plus companies, look, I mean, we've seen a massive uptick in terms of multiples if you compare back to like 2014, 15, 16 versus today. There was some pullback since 2021, but we have seen a couple processes where you have a lot of scarcity and a strong desire for top of the house initiatives for sponsors to deploy, and they will get pretty aggressive on multiples. But I think as Christen and Bobby had mentioned earlier, A assets are out there, but it's not that wide in terms of the number. It's really kind of a focus on quality and making sure there are no really what ifs in terms of going to investment committee and getting them comfortable with it, maybe being able to underwrite. I think that gap in terms of seller expectations to buyer expectations, has kind of come a little bit further together. But we have been seeing for an A asset, good stability in terms of what multiples would look like.
Okay, and Bobby, let me ask you, given what could be coming down the pipe, are you seeing any indication of companies that are maybe under some stress and really need to find buyers for that reason?
So it's not so much that in terms, and we'll see what happens this year. We haven't seen the growth in terms of businesses that are getting into tripping covenants and being forced into service situations. What we are seeing that's interesting here is, and this is the hope of what this year was, and it pulled back a little bit, is those businesses that weren't performers, that have been in portfolios for 7-8 years, were being held onto, and they weren't being sold in the M&A markets of 23, 24. This year, our view from the start was always those high quality assets are going to be coming out. Those will always get the interest. But what we've seen come back is those businesses that have been on the shelf that they've been waiting on for that perfect environment, where now, to James's comment of, you are seeing buyer and sellers coming a little bit closer together, and you're seeing those sellers say, okay, we're going to take what the market's going to give us. It's time to go find a solution for these assets. We've held them long enough. So no heavy growth in terms of assets that are getting into restructuring type situations and being forced into sales. But what we are seeing is assets that are what I'd call the Bs start deciding to come to market and just take what the market's willing to give them.
And Bobby, those are by and large private equity sellers then that have held companies for the they're 7-8 years, maybe longer than the typical holding period. And Bobby, and what about multiple for those B companies? Bobby, what kind in the industrial space? What kind of leverage are you getting? Are creditors willing to put on those? What kind of valuation multiples are they getting?
Yeah. So it's hard to paint a broad brush because every business and sector is different. So a good multiple for one sector could be 8 times. A good multiple for another sector could be 12 times. What I'll tell you is we hope this holds up. The financing packages we've seen for assets has exceeded our expectations. We had a couple of deals we signed up here in the first quarter, and the lending partners out there are eager to put money to work, and they've gotten aggressive. We've heard PE firms saying they're getting packages as great as they were back in kind of 2021. And what we're seeing versus the past couple of years, and hopefully this maintains through this year, is the financing not being the long pole. That's a check mark. People are getting what they need there. So the question then becomes, from the other side of to your multiples perspective, I think multiples for good businesses have maintained, if not grown, because people are there's a flight to quality right now, and then it just depends on the space, right? As I talk about data center and that type of stuff, if you're talking about teams type multiples. If you're talking about larger systems type businesses, stuff that's more project oriented, stuff more in kind of the heavy duty truck and serving those types of OEMs, those are single digit type multiples. So I think every subsector is going to be different from a multiple perspective, and then it's a matter of all the criteria within that business and what makes them on the high end versus the low end, whether it's consumable products, margins, differentiation, all the stuff that we go in and talk to our clients about that defines where they sit on that spectrum within that subsector.
Okay, thanks for that color, Bobby. Christen, let's go back to you. And simple question: are you a buyer this year? Are you a seller? Are you both? What are you?
I think we'd like to be both, probably with a little bit more of a bias to sell companies right now, just given where we are in our life cycle, and our strategy is very operationally hands-on. So having a bloated portfolio is very it can drain resources, right? So we'd certainly like to sell some assets this year. I think that just given that the deal market has been depressed in our space over the last 24 months, we've really been able to focus more acutely on our portfolio and driving equity value creation. And part of that has been thinking ahead to the exit preparation process, so much so that we actually started a team within our investment team that focuses on exits and realizations and prepping companies earlier and earlier, especially as you see some of these processes stretch out longer than they have over the past few years. So it's hard enough to sell a business in good times. So a lot has to go right. So we've been taking actions to try to optimize, our processes, prepare our companies so that the narrative is well supported by readily available data. We don't want to be the holdup in that. So, we've seen just from even the processes on the buy side, we've participated in a lot of activity from strategics and sponsor-backed strategics, which makes sense. So we've spent the time over the past year not only thinking about, our portfolio, but we've started cultivating relationships with logical buyers, ahead of even engaging bankers. And oftentimes it's strategics, but in some cases we're doing our own sponsor coverage effort as well, where we're speaking with logical buyers there, because we feel that for the right buyers, we can kind of provide those updates, explain our story in a kind of low pressure environment outside of a process to understand who might be the most interested when we actually are ready to sell. So that's something that we've been focused on and will continue to do more of. I think, where a lot of investment committees are risk off or pretty risk averse right now. If you kind of drop a sim on their desk cold, it's hard, to kind of, build that conviction with a lot of investment committees if there's no advanced education process or edge or thesis around a given asset. So we're trying to do our part to educate, logical buyers on our assets. So it's been an area that we've focused on, and we employ the same philosophy on the buy side. We try to figure out which assets that we know about should be coming to market. We don't know, exactly when they're on our watch list. We're using the harvest report that Sutton Place puts out and thinking about, what lines up well with our strategy. How can we compete? So, for sponsor-owned businesses, again, that could be building that bridge with other sponsors and doing kind of like a portfolio review that goes both ways. And understanding some of the challenges they've been through with their company since the pandemic and just getting the nuance of those stories. And even if there's not an opportunity to kind of create a bilateral discussion there, at least we're building some early conviction amongst our own investment committee. And so, that alone, I think, provides sellers with more conviction or more certainty once the business does come to market. So we're trying to do some things well ahead of real auction processes here. And then I think outside of sponsor to sponsor trades, we are also kind of thinking about the corporate landscape. I mean, corporate carve-outs line up really well for our strategy. And, as mentioned, strategics have been pretty active on the M&A front. So we've already started to see sort of a pruning of non-core assets from a lot of large industrial conglomerates. Hopefully that continues. I think it kind of depends on what happens to their stock price and, their appetite to kind of part with certain assets at a given time. But we've already seen, corporates as a seller tick up a bit in recent months. So, that's another area where we're definitely leaning on our banking partners to understand, where there might be something to do that, we may be able to provide a solution to them. So those are some of the areas that we're focused on, from a buy side perspective.
Okay, and let's we hear so much about the demands for liquidity from LPs out there. I wanted to maybe start with Bobby and then go back to Christen, if Christen is willing to tackle this one. And Bobby, the question for you is, how much interest are you seeing from sponsors in doing alternatives to outright sales, such as creating continuation vehicles or doing these NAV loans as a way to generate some liquidity at what may not be a great time to sell, for many companies?
Yeah, well, I take the 10,000 footer. You look at banks like Moelis, ourselves, and others, how much we've invested in terms of within the private funds advisory continuation vehicle space. So that should tell you everything, right? It's been hugely popular the last few years, creates kind of an existing fund realization. So it allows you to retain ownership and kind of raise growth capital. It creates, if you have an A+ asset, you just don't want to sell, you want to continue owning, or it's just not the right time and you're at the end of life. It's just a great alternative. So, what we've found when we're going in to talk to PE groups about potential sales, I'd say a majority of the time now, it's not just a conversation of a sale, it's a conversation of a sale/CV and what can make sense there. We've had multiple deals that started out as engagements related to sell-side M&A, and before we even decided to go to market, we've flipped that over to doing a continuation vehicle. So it's become a great option in the space. I think, part of what's pulled back also in M&A, it doesn't help the M&A markets because there's these new alternatives. So it's further in terms of less deals out in the market for that dry powder. But from the perspective of the advantage to the middle grounds of the world and the like, it's a great another alternative to create different options in a very tricky M&A market that exists out there.
And Christen, are the CVs an option for middle ground capital, and how do you think about them?
Yeah, for sure. We actually did our first one in the fall of 2023 with a Fund 1 asset where we were actually thinking about, selling it outright in an M&A process, but a large acquisition that we had been chasing for a few years finally became available, and there was no no more dry powder in Fund 1. We had already moved on to deploying our second flagship fund. So a CV was a great way to, be able to kind of pull off this acquisition and also return some capital to our Fund 1 investors. It was a really good outcome for them. A lot of them rolled in the transaction as well. And we had one of our LPs step up and anchor it in a big way. So it was a good process. We actually ran it in-house. So hopefully we can give James or Bobby the business next time. I think there were some painful learning lessons from doing that, but we're looking forward to continuing to build that platform. There's more capacity to do further M&A there. And then as far as, in this environment and doing more, I actually think there's an asset or two that we would like to do another continuation vehicle for, but we're kind of in this unique position of being a Fund 3 and raising our third fund right now. So actually posting some nice clean exits where we're not selling things to ourselves is attractive to us, and LPs really don't view a CV liquidity event in quite the same way as a clean exit. So I think there'll be more on our radar in the future. And I was having a conversation last week with Merger Market about CVs on CVs, so CVs squared, and I guess we'll see where that market goes. I mean, that seemed a little wild to me, but a lot of the early CVs are starting to reach that point of what's next, what's the exit path here, and so it'll be interesting to see how that market continues to evolve. It's evolved a lot and grown a lot over the past few years, so I think it is a very real option, for a lot of sponsors.
And Christen, as you think about CVs, is it really only for those A+ assets that you love and just would like to hold on longer, or is it for other kinds of assets as well?
For us, it's for doubling down on winners. I think that's that may be different for other sponsors, but I do think the CV market has moved more in that direction versus kind of, okay, here's a zombie asset, we don't know what the plan going forward is, so we're going to pop it into a CV. I think you're seeing less of that.
Okay, we've got about 15 minutes left in the program, and so I want to make sure we get to any questions from the audience. So I'll make a impassioned plea for any final questions from folks. We've got a few that are queued up already, but please submit some additional ones. And we'll also switch gears a bit and start talking about kind of the nuts and bolts of deal sourcing, practicalities of deal sourcing, and really interested in getting advice from James and Bobby and of course Christen into sort of what's working today in deal sourcing and maybe what's not anymore, given what's going on in the economy this year with the trade wars and the prospect of recession and all the rest. So when we have a question that comes in, it's just read it. It's very clear that we're in a new world. How are you thinking about sourcing strategies in a world of new rules for global trade and economics? And James, why don't we start with you? Actually, why don't we start with Bobby this time? Bobby, how should your clients, private equity firms, be thinking about sourcing strategies this year as we speak with everything that's going on?
Yeah, what I find is the world of what the assets are out there that are PE owned. So let's talk about those. Are pretty defined, right? They're out there, and I think if you're going and there's something you like and you're waiting to see for it to come to market, you're too late. And the groups that are getting the assets that they're committed to and like are there early on. I think that open communication, I always talk about it with the BD individuals or the others at PE firms, is creating that connection point where it's a two-way street. I think it's really important to understand the best in business development within the PE community realize it's not just taking information from bankers, it's what can they give going both ways. And from that, you start getting the intel and thoughts of, hey, what are those assets that could fit well for us that we should be in front of, and making those connections early on. One of the biggest things that's happened within our space is these private capital conferences, right? All the banks are doing them where they're introducing. I think a lot of private equity groups are much more open to having their assets present early on, because it used to be the old days of when assets come to market, that's when everyone sees it for the first time. You run an auction and there it goes. Quite frankly, these days, for the best assets, they're not even getting through a full process. Those groups that have been in front of it that want it are doing everything in their power. So in an environment like this, where there may be less assets out there, less quality assets, if there's something on your radar, get in front of it early, get the introductions, leverage your investment banks who may have the connections to have those discussions, because we're seeing a much different world in terms of people being open to allowing people to get to know businesses and management teams early on. So when the time does come, they're able to jump at it, because there's going to be a lot less assets of quality out there right now, as there have been the past few years. So when those do come along, you want to make sure you put yourself in the best position. And to me, it's getting there early and having an open and honest connection and relationship with the banker where you're very communicative and you listen. And those are the ones where we find people are very successful in terms of winning out on those assets that they want.
And Bobby, is it better to approach the investment banker first if you're interested in kind of checking in on a company that you anticipate will be coming up for sale in the next couple of years, or should they go right to the company itself? What's best?
Yeah, I'd use every approach that you can. Obviously, you could take a look if there's an investment bank that sold that business to them. They probably have a very good connection point, right? Or an investment bank you've seen done a ton with that private equity group, where you could say, hey, can you put in a good word and get us that access? At the same time, people like Christen have great relationships, not just with all the bankers out there, but with other private equity firms. And I think the more you show, the more proactive you are, and all the different routes you take will all be beneficial. So I don't think there's one right answer to that. I think it's leveraging all the relationships you have to be able to get in there and make it known. Because when we're running those processes, when we see bids come in, we see people come after it, we know who's been going after it, who's real versus who doesn't have the conviction yet. And that comes into play in a risk-off type environment. Is we need to make sure we're spending the right time with the right groups. And there's nothing worse than putting all our resources into one group who ends up like that, fading away and saying we're out. So again, I think it's using all of those avenues is key.
And to maybe double click on that with a real example. I mean, one company that we bought last year was Ellis Sterrett, a public company that part of our sourcing strategy is looking at, kind of small cap industrial businesses who aren't necessarily getting the benefit of being a public company. And that one was on our radar for a long time. And I think it was really exciting to our operators because they had great familiarity with the product and the tools that the company made or makes. And, we had sent some letters to the board, saying, hey, we're really interested. Wasn't the right time for them, but wanted to express our interest early. And this was a process that Bobby and his team ran. And, when our managing partner got to the management presentation, one of the letters that we had sent to the board was, shared and held up and said, and it was why I think were included in that process, is probably in large part due to the early overtures that we made. So it's hard to sometimes measure the ROI on some of those activities, but when you do that, I think it really can pay off in a big way, and we ended up prevailing in that process.
Yeah, and to keep you the behind the scenes on that, the owner of that business, private company, he didn't know much about the space, and he came to us and he said, hey, listen, here's the groups that have really been pinging. One of them's MiddleGround. What are your thoughts on that? And they take that view. And when we were making decisions of who's coming through, who to spend the time on, putting in his mind who could be the potential owner for that business, he's looking to us. And again, that's where all the relationship and history comes into play. And MiddleGround played it very well by being in front of him. It was never the right time, but they were very aware of that interest, and they came to us and said, hey, do you know who this is? Because they don't know the industry. They don't know the PE groups out there.
Hey, Christen, I imagine that from the perspective of a seller or business owner that might want to sell at some point, that outreach from private equity could potentially be annoying. It could potentially be wonderful. And can you tell us how to keep things wonderful, and so that when that meeting, when the management meeting comes up, you're remembered favorably, that you got in touch with us as opposed to unfavorably?
Yeah, I mean, I think there's very little, especially someone who spent time on the BD side, there's very little that annoys me when someone is trying to build a connection, especially if it's over a specific asset that they have interest in or that we may have interest in. So I certainly don't mind it. I would say over the last 6 to 9 months, we've probably had more inbounds across our portfolio than we have, in the past few years. And part of that is just the maturity and where we are, in the life cycle of building our firm and our funds. But I would say that, we entertain those conversations. We're happy to have them. And I think it's always really great to have that personal touch and know who's on the other side of the table because, oftentimes when buyer lists come together, bankers are sending them to you and we're saying, well, what's your experience working with them? We're leaning very heavily on, have you transacted? How do they behave in a process? How do they hold up on value? Do they do what they say they're going to do? And I think when you can build that in, that personal direct connection, it gives you more confidence in their ability throughout a process. So it's another factor that kind of goes into how groups maybe get prioritized and how you kind of think about tiering out your buyer list. So I think it's just very additive overall. I haven't had any conversations that, I think have gone south or sideways. I think they've all been, generally additive to the process as a whole.
Okay, thank you, Christen. Bobby, there's always a lot of interest in how you put together your buy list for a particular asset, and also how broadly you're going out to potential buyers, like at this moment, because I know that changes over time. So how broad are your processes right now, and how are you putting those buyer lists together?
Yeah, to answer the first question, how broad, it's funny, there's been a little bit of a shift. I think we went through a situation because of 21 of very tailored small processes. And obviously, it was a very different environment. With the environment we're in now, we're going back to, you see a lot of deals where there's less in the market, so the investors have more time. You see more people putting in bids, but it's tougher to decide who's real and who's not. So you see a post MP drop off that's larger than we've seen historically because people aren't getting the full conviction. Like in 21, when they had a ton of stuff going on, they were picking, hey, here's the business we're going to go after, and we got to have it here. I think there's a little bit of the decision making that happens probably a little bit later on. So what we're seeing is a little bit more of a hybrid. We still have a view of who the best buyers are, and we'll treat them special, and they'll have those direct conversations. But at the same time, we have a lot of clients that still want to make sure that we're canvassing the space. That comes on the back of the banker, and it's for us to go figure out. But you'd be shocked at the number of times where the group that we thought would be number 25 in the list as ranked of a strategic acquirer ends up actually buying the business. And that's why we do our job. Now, as we think about building buyers lists, in no way are we building buyers lists once we're getting engaged. Those have been built over years. And it goes back to what I was talking about in terms of introductions. Good bankers within their space are, especially in today's world, are very sector focused. I've got my certain subsectors. I know who the strategic acquirers are in that space. I'm having often conversations with them and identifying private equity owned assets that should be high on their radar. That can create introductions where I may call Christen and say, hey, here's a group that you should, that want to get to know you. They know you're not for sale now, but hey, let's have some conversations. Same thing on the private equity side with these conferences that happen and other introductions. So that buyers list of the top buyers kind of evolves over time. So by the time that we get engaged, we already have a good sense of who those top 20 or 30 groups may be. Now, there's a broader set behind that comes on us to go check and do that process check if there's anyone else out there. But that buyers list has been built over time if it's a good banker who's been in front of the business for a while.
Okay, and we've got about 5 minutes left, so we want to do a final lightning round. We're going to ask each of the speakers to go in turn. We'll give Brenden the final word on this. But what we want to hear is we want to hear about a favorite, in the case of Christen, portfolio company and why you like it. And with Bobby, it would be more maybe one that you've recently sold or representing. And Brenden, we'll leave it to you how to answer the question. But let's start with Christen. Favorite portfolio company?
It's so hard. It's like picking a favorite child. But I'll go with one that's, matured and, we're kind of nearing the end with them. But a company we bought in 2021 called Aero True Line. It makes garage door hardware for residential and commercial end markets, both new construction and repair and remodel exposure. So like the diversification component of that, very sharp management team who has done a lot to manage the business really well through kind of the current, interest rate environment and housing cycle, or where we are today. And, I think they've been very capable. It's an area where we've been able to vertically integrate by bringing some capabilities in-house on spring manufacturing and on our tube mill, whereas a lot of our peer set will source those components, some internationally. So from a tariff perspective, really well positioned relative to our peers. And are looking forward to, it's been private equity owned several times. I think, this is a great asset for another sponsor to grow kind of beyond the garage door space. There's some great opportunities in manufacturing synergies across the solar end market, across fencing. So, think somebody who wants to kind of build on to this both organically and through M&A can take this, to the next level. And then I think it's very attractive to strategics as well, because it's, some of the metals players, as an example, kind of coming downstream and getting sort of this higher margin business with really strong free cash flow conversion, I think is quite attractive in this environment. So, certainly looking forward to sort of the end of the road with this one.
Okay, well, we'll keep an eye out for that one. And Bobby, what's a favorite?
So I'll play two areas. One, I'll talk in terms of a space that's had a lot of deal activity. Going back to what I talked about earlier, the filtration space has been a lot of fun. We sold Columbus to Filtration Group, the Rensa business to Audex. We publicly announced a business called Micronics to Clanova, which is a PX3 owned asset. That's been a space that's continued to see great outcomes, and just given the scarcity of it, every one of those deals just gets tremendous strategic interest. I'll also play to our panel here. The LS Sterrett deal was a great one. It was a fascinating deal where you had a public company. You don't have a lot of take privates in our space, and it was a public company that had still had, the Sterrett name on the door for 4 generations, and it was a fantastic brand that just needed some institutional ownership behind it. And it's a brand that's well renowned in the space that everyone loves. It's been around for 100+ years. Rarely are you've seen businesses with this type of longevity. And to your question about, ones where we see great prospects, that's a great one, because you go inject in the arm of that business someone like MiddleGround, and there's just so much you can do. And I know they've been up to their eyeballs with all the opportunities that exist there. You walk through and see it. And so that's just a very different type of situation, a very different deal than we usually see, which was very interesting to handle.
Okay, thanks, Bobby. And Brenden, the final word.
I think, technically speaking, my favorite portfolio company has to be with Intelligence, considering that they acquired us. We're certainly focused very heavily on the data integration space after a couple other recent acquisitions, which is certainly very exciting, and it's a fun challenge to be involved in. But just completely separately, in terms of a space that seems pretty interesting, is certainly gaining a lot of pace. Wasn't seeing too much of it in PE, but it seems to finally be getting in there. Would just be drones across the board, broadly defined, whether it's complete devices, parts suppliers, software and data processing. You can see there's an entire ecosystem that's coming up around this, and it has applications across industrial, oil and gas, inspection of solar and wind, above ground, deep underwater, so on and so forth, and even competitive racing. And we all know what esports has done for the price of GPUs and partially contributed to NVIDIA's rise. It's not just crypto. So curious to see where this one goes. Expect to see a lot more in it.
All right. Well, we're going to call it a program, and I've certainly learned a lot about areas like now drones and data centers and filtration, and hopefully we'll get the boom that people are hoping for later this year in the M&A market. Let me thank our speakers for doing a wonderful job. Brenden Gobell of SBS by With Intelligence, Christen Paris of MiddleGround Capital, Bobby Reifman of Lincoln International, and James Schiro of Moelis and Company. I'd like to thank our sponsor for underwriting the cost of the program, SBS by With Intelligence. And I'd like to thank all the attendees for coming. Please have a wonderful rest of your day.
Thanks, everyone.
Take care.